Your bank account is bleeding out because of a $1.7 trillion debt trap that was engineered in a boardroom. In 1992, an obscure shift in the Higher Education Act quietly uncapped borrowing limits, sparking a tuition arms race that shows no sign of slowing down. Today, that policy choice is the invisible engine gutting the savings of millions, forcing students into a lifelong cycle of interest payments that keep them permanently shackled to their degrees. Get to it. To understand where we are, we have to look back at the 1960s. Before this era, higher education was largely funded through state subsidies and personal savings. In 1965, the Higher Education Act was signed into law, effectively creating the first federal student loan program. At the time, it was intended to be a safety net, a way to ensure that talent, not just wealth, dictated who could attend university. It worked at first, but the program lacked the mechanisms to control the cost of the underlying product, which was the tuition itself. Think about that for a second. If you subsidize a demand for a product without limiting the price the provider can charge, what happens? The price goes up. It's a basic economic feedback loop, yet we ignored it for decades. By the late 1970s, policymakers realized that private banks were wary of lending to students without collateral. So, the government started guaranteeing those loans through the SLMA or Sallie Mae. This took the risk off the banks and placed it squarely on the taxpayer. When banks stopped fearing default, they stopped vetting the quality of the borrower. That shift changed everything. Suddenly, billions of dollars were flowing into universities, and administrators realized they could charge significantly higher tuition without losing students because the government would just increase the loan limits. It was a golden era for college growth. You saw the expansion of campus facilities, the creation of high paid administrative positions, and the rise of the student service model. All of this was fueled by debt. Fast forward to the early 2000s, and the landscape shifted again. The DRA, or Deficit Reduction Act of 2005, further streamlined the process of lending. Universities weren't just competing for the best students anymore. They were competing for the students who could secure the largest federal loan packages. If you're finding this history useful, hit subscribe. I drop videos like this every week to help you understand the forces shaping your financial future. Now, here's where things get interesting. We often blame the schools for high costs, or we blame students for poor choices. But the real issue is structural. Consider the story of a public research university in the Midwest. In 1980, this school received nearly 60% of its operating budget from state appropriations. By 2020, that number had plummeted to less than 15%. Where did they get the money to stay open? They raised tuition by 400%, adjusted for inflation, over those same 40 years. When the state pulls back on funding, the institution looks to the only available revenue stream, the student. And the student, in turn, looks to the federal government. It's a cycle of desperation disguised as opportunity. But wait, I told you there was a third hidden factor that makes the situation even more complex. This is the one I've been saving for you. It's the role of the for-profit education sector and the regulatory capture that followed the expansion of federal lending. Between 2000 and 2010, the number of students enrolled in for-profit institutions exploded by over 200%. These schools were experts at leveraging the federal loan system. They targeted vulnerable demographics, promising career advancements that often never materialized. In 2012, a landmark report from the United States Senate Committee on Health, Education, Labor, and Pensions found that for-profit colleges were receiving massive amounts of federal aid while having some of the highest dropout rates in the country. The industry had become so efficient at extracting federal dollars that the education itself became an afterthought. They were selling the loan, not the degree. Think about the implications of that for a moment. You're not just paying for a classroom, you're paying for a marketing machine designed to maximize your borrowing capacity. Let that sink in. When the product is the debt rather than the knowledge, the incentives for the institution become perverse. They don't want you to graduate quickly. They want you to stay enrolled long enough to tap into every available semester of federal aid. They don't want you to pay off the loan. They want you to serve the interest for decades. This isn't just about bad actors. It's about a systemic alignment of interest that puts the university, the lender, and the federal government on the same side of the table. The student is the only one sitting on the other side, holding the bill. So, where does this leave us? We are currently living with the consequences of half a century of policy decisions that prioritized access at the expense of affordability. We traded long-term stability for short-term enrollment numbers. We allowed tuition to decouple from the actual value of a degree because we made money universally available regardless of the outcome. It is a lesson in how good intentions when backed by infinite credit, can produce unintended results that span generations. There's no simple button to reset this. It will require a fundamental rethink of how we value human capital, how we fund our public institutions, and whether we continue to treat higher education as a commodity or a public good. The path forward isn't just about loan forgiveness, it's about preventing the cycle from resetting tomorrow. It's about transparency in institutional outcomes, accountability for administrative growth, and a recalibration of state level investment. So, there you go. A look at how we got here and why the system is so resistant to change. The $1.7 trillion question isn't whether we can afford to fix this, but whether we can afford to keep going the way we are. If you got value from this, share it with someone who needs to hear it and subscribe so you don't miss the next one. We're going to be looking at the future of the job market next week, and the data might surprise you. Take care, and I'll see you in the next one.